Welcome, everybody, back to another episode of Cash Flow Positive. I'm your host, Kenny Bedwell, and we're going to be talking about commercial lending today, but it's going to be fun and interesting because the fact of the matter is, as you scale and grow, as I've been teaching you over these many episodes so far, there will come a time and point where you should use some sort of or consider commercial financing, maybe even for your first property. And so I wanted to bring on one of the best brokers that I personally know, Matt Stout, the STR Loan Guy. This guy's done over 4,000 transactions over the last 30 years in the lending space. So he knows a thing or two about mortgages. And he's also heavily involved with lending in short-term rentals in the last few years, has a short-term rental himself. He's building another one too, and we're going to talk about that and that interesting adventure. And so without further ado, Matt, tell us a little bit more about yourself.
Thanks, Kenny. As the STR Loan Guy, I've been specializing in short-term rental loans for the last 2 years. But prior to that, I came from a 30-year experience in regular mortgage world, doing traditional mortgages, funded over 4,000 transactions. And that whole time, I've always had the mindset of a real estate investor because not just a loan officer. And I try to take people through a journey of how can they better position themselves so that they can buy more properties.
Gotcha. Cool. That's awesome. So I gotta ask, you said last 2 years you've been doing STR. So what got you or STR mortgages, what got you into the short-term rental mortgage side?
Prior to that, I had done some here and there, but as I got into it more after buying my first one during COVID, I realized that most lenders just don't know what they're doing, or they have, challenges in underwriting. You can put it that way nicely. So I felt like I needed to solve it because along the way, I've pretty much done it all in mortgages at this point, and was getting kind of bored. So I figured, let's give it a try. And it was interesting because I didn't expect the types of lenders that were really getting stuff done, and it took quite a bit of research and calling past clients that owned STRs, and going all the way through different networks, and really trying to figure it out because at the end of the day, I didn't want to say I could do something if I couldn't do it well. And once I got involved with it, it really was a huge fit for me because I've always taken the mindset of trying to show people how they can use that debt equity in their home to buy more properties. So it was just a natural fit at that point, and I really enjoy it.
Gotcha. Okay, great. And do you have any short-term rentals right now yourself?
Yeah, I like a lot of people. I bought my first one during COVID and bought it from an emotional point of view. And, it was my dream home, and it was a bonus. I could rent it out and I'd be able to use it. Made a lot of the same mistakes I think people make when they buy their first one. But I've since been able to leverage that property, and I'm now building two cabins near Zion's, which is interesting because I'm not even a hiker, but it makes sense. It just, the numbers work. And I've been able
Nice.
to apply what I've learned doing STR loans to an actual property that's going to make money, not just be, you know, a toy.
Yeah, yeah, for sure. Yeah. So that's awesome. So where was your first property you got?
It's on Crescent Beach. It's an awesome oceanfront property. It's just about 15 minutes from downtown St. Augustine.
Okay. All right, right on, right on. So and you
Yeah,
said
and
you
I'm
sold
doing.
that one or you still have it?
No, I still have it, and it's still my retirement home. I just, I've turned it around. It's gone from barely paying the bills, and now I'm a super host, and really deep dived into it this last year on how to, market it better. And I believe this next couple months I'll be in the top 10%. I'm right there, but not
All
quite yet.
right. Cool. That's awesome. That's really,
Yeah,
really
it's been
cool.
good.
Sweet. Yeah, and then Zion, building around Zion, that's a beautiful national park and lots to see and do there. So that's exciting. Are you going to do it north of Zion or in the south or closer to St. George?
It's the new Eastgate that's opening up in Orderville, and
Oh,
there's
okay.
there's a lot of development going on in there. Up until this last year, there was very few vacation rentals in there, but it happens to be in a pocket where you're still allowed to do that, which is really hard to find.
That's awesome.
Um, and
Yeah,
not only that, but I've got an opportunity where I can do an ADU and have them both be legal STRs. So
great.
it's
There
hard to
you go.
find that anywhere, really. So that's been a big push, and I'm excited for it. And going to be converting another long-term rental I have in Salt Lake City as well to an STR this year, which is 30 minutes from 7 ski resorts, which is also me not trying to be emotional because I'm not a skier. I have a beach house for a reason. I hate the
Yeah.
cold here. Where I'm at in Salt Lake City, it gets cold and it just drives me nuts. But I think it'll be a good property. So
Nice, nice. How often do you get out to Florida to check out your beach house?
just unfortunately, I've got a lot of reasons. Not unfortunate, but a lot of reasons that I'm still here. I have little kids. I'm really grateful for that. I'm really blessed, and they're still in school, so we only make it out there for maybe 3 4 weeks a year at this point. But I see that changing in the
That's
next
still
couple years. But
that's still pretty decent though, but
yeah, it's been good.
it's not
It's
bad,
been
especially
good.
deep out of Florida, right? So
Yeah, and even though St. Augustine is pretty cold in the winter compared to, like the Keys, we used to have a place there, but it's definitely a little bit out of the way of Hurricane Alley compared to my last place. So I'm glad to be there.
yeah, that's awesome. Cool, cool, cool. Okay. So curious, these 80 the these this cabin that you're building in near Zion,
Yeah.
are you what type are you doing any special financing with that, or what type of financing are you doing?
That's always a challenge. Unfortunately, I am connected to a builder that's willing to finance it for me
Okay.
because there really is not special financing for short-term rentals that I've been able to find. There's some difficult financing and some expensive financing, but um, the type of financing that you need to do, like a one-off spec home, is pretty hard to get without using regular traditional tax returns and stuff like that, which I could do, but I didn't want to do it that way. I wanted to purchase it in an LLC with a DSCR loan, solely for the protection purposes. But
Okay, this is interesting. I mean, let's talk about this. I think we should dive into this because I think it's you're probably doing something a little more complex than other people are doing, besides just getting a DSCR loan on a already built short-term rental, which we'll dive into. But tell me, okay, so you went to the builder to get this loan, and he's offering a DSCR, or tell me like what's the how does it work?
so in my case is very unusual. I actually am connected just from my experience in the mortgage industry to lots of builders. I've been doing financing for all kinds of people for many years. So I was fortunate enough to know a builder that was willing to bankroll the actual construction piece. So once it's completed, I'll just buy a finished product, which is how a lot of new homes are sold. But it's
Hmm.
pretty rare that you're able to go in and do a spec home in a remote area. That's just kind of a one-off thing with a builder that way. Typically, the way you have to finance it is you buy the ground, you get a construction loan. Well, that construction lender doesn't usually have DSCR type loans that are going to be out of your name. They're going to want it to be with tax returns and all that. And, it requires a much different type of financing.
Okay,
But in my case, I'm able to go in and just purchase it as a finished product.
gotcha. Are you so with this because you don't have you do you own the land that the property's on right now, or you will own the land?
I bought the land and I'm actually selling it back to him as he's starting to build. And then I'm going to purchase it from him again once it's finished.
Oh wow. Okay, so you own the land already, and then you found this opportunity, and then I guess so. This is really interesting. So is the builder? Did you give him some sort of like down payment or earnest funds or anything like that for this deal?
Yeah, I actually had to pay off the ground in order for him to do it.
Okay, gotcha.
So he takes title with all the equity in the land, which seems
Okay.
pretty secure.
Yeah, so he's taking the land, but he's financing or he's covering all the costs of the build, and then
And
you're
that's going to be my essentially my deposit into the deal. And then when it's finished, I'll purchase it from him.
that's really really fascinating. How I mean, obviously you know the builder and the builder knows you, so there's a level of trust and connection there. But how how difficult is that? So let's take some of our listeners, for example, who are maybe
Yeah.
interested in building, and this is something unique and different, and they want to do it through an LLC and do a DSCR loan and all that. What can they replicate that same process? Can they go out and find a builder and do the
I
thing?
I wouldn't think it's going to be that likely unless they know one. Especially with as difficult it is to find builders right now. They can kind of pick and choose, and the last thing typically interested in is bankrolling your project. So,
Right. Okay. Gotcha. So
but I
what
am paying a premium for it. I mean, but it has, in my case, it has some tax benefits that make that worth it.
Sure, sure. Okay. So what's the best way for someone to do that though, if they're interested in building?
Well, I would suggest if you can keep the loan amount under the conforming loan limits, we have some pretty cool one-time close programs. They do require tax returns. You wouldn't be able to purchase it as a DSCR, but you could qualify on just 1 year's worth of income and do a one-time close where you can have a builder come in and do a one-off home for you. You can finance on an investment property up to, I believe, 80% of the total cost.
Okay. So it would be considered an investment property at that point. So
There is a second home option, but I believe it's not much better. It's as far as the terms go. I think there's about a 5% LTV cap, but um, new construction is a challenge when it comes to investment properties. And while there are investors out there doing it, that'll do it on more of a DSCR, they tend to want the builder to have some sort of skin in the game, where they want them to be a partner in the deal or sign as a personal guarantee, and that can be difficult.
yeah, I can imagine. So building for those listening comes with some strings attached, it sounds like. So beyond just finding a good builder and reputable builder.
It's just not evolved yet to the point that regular DSCRs, we can use short-term rental income. We can close an LLC on something that's already finished.
Mhm.
But the moment you break into new construction, you lose 95% of the lenders that do that type of deal.
Mm,
And so it gets to be challenging, and you're left with more commercial asset based companies that they would probably, if you had a large portfolio, you could probably get them to let you cross collateralize or something and do construction that way. But typically they want to see uh, more experience on the builder's side. The builder has to have a much longer resume, especially if you're doing a spec home.
gotcha. That's very interesting. I think it's really good for people. A lot of listeners who are trying to scale and grow. I've heard a lot of people wanting to build and do these projects, which sounds great, but might be a little bit more complicated than one might expect. So,
And
uh,
definitely start with your cash on cash calculation, because
yep,
you're going to be into it a lot more capital with any kind of build than you will if you can find something existing almost every time.
yeah, yeah, I believe it, and also holding costs too. So,
Yeah,
yeah,
yeah, and the interest costs. I mean, you're going to be down just the time it takes to get it built and launched. I mean, you're losing that much time right
right,
there.
right. That's interesting. Okay, cool. Well, that was good to know. Not really the direction I was originally thinking this was going to go, but that's okay. That's how these conversations go, and that's fine. I
Well,
do
I
want to.
wish I had better answers for you with
No,
construction.
no, that's
I
fine.
trust me, I get a call a week from somebody wanting to do it, and it's like, well, DSCR isn't quite there yet, but we do have some great DSCR products. We're able to do things like use Air DNA, which isn't always the greatest data. A lot of times, we'll take data that you have with STRs insights and find comps and use appraisals like that too, and we can get them approved that way.
Yeah, yeah, that's great. So I want to take a step back, um, and just kind of talk about first off typical lending options for someone looking to acquire a property. Okay, so let's go high level. Let's keep it simple, and not go. We'll go deep in a second, but
Okay.
layman's terms, what are my typical like loan products that I'm going to see as someone coming in who's looking to maybe acquire a home that is already a short term rental. Doesn't matter if it is or isn't.
Okay. Uh, a lot of it comes down to your experience level, because there are different lenders. And if you're, for example, a first time home buyer, you're going to have a much more difficult time finding a program than if you already own your primary residence. And then if you've had experience as even a long term rental owner and having more than one property in the last couple of years, your pool of lenders opens up and there's a lot more choices for you. You also have to ask yourself, what kind of down payment are you looking at? If you're thinking of trying to do this with just 10% down, you're going to have to qualify on your personal income and not use any income at all from that property as a second home. Versus if you can put 20 to 25% down, you're going to have a lot more options where we can use things like AirDNA or existing history from the STR to qualify.
Gotcha. Okay. So let's talk about that because I mean that's really the title. Should I use a commercial loan for my STR purchase? So number one, it sounds like it requires a larger down payment overall.
It typically does. We have commercial products that'll do it with as little as 15% down, but your interest rate's going to be in the high eights. Versus if you can put 20% down, you can get under 7 a lot of times, depending
Gotcha.
on that DSCR ratio. A big question that you have to ask yourself too is how important is it if you have this thing on your credit? A lot of people don't care. Personally, I don't think having a mortgage rating on your credit is going to hurt you. But if it's absolutely critical to you that the loan is not going to rate on your credit, you're going to have to go with a DSCR lender that specializes in that. And that can be a challenge with some lenders.
Sure, sure. And to clarify for everyone listening, DSCR stands for debt service coverage ratio. Matt, tell us how that name came about, what that means for this particular loan, DSCR.
Well, it's as simple as the property qualifies for itself. So if the cash flow from that property, depending on how it's underwritten, and there's a ton of ways to do it, but if the underwriter feels like the property can make the payments, then we stop asking for paperwork from you. The property is approved on its own credentials, which has its merits, and it can be a great thing, especially if you're like a lot of investors or self-employed people that have a difficult time documenting your income.
Gotcha. So for everyone listening, typically when you go to a bank, especially to purchase a short-term rental, they're wanting like they don't see short-term rentals. Most banks, and Matt, you correct me if I'm wrong. Anyways,
Right.
I'm gonna tell you, most banks don't see short-term rentals as a legitimate asset class yet, right? So they're not looking at a house. Oh, it's a short-term
Yeah.
rental. We're going to give you a loan purely based off that. It's basically qualifying. You're qualifying it based on your income. Can you afford another mortgage payment based on your income that you're currently generating?
Yeah,
And
they're using your income and assets, and they will consider rents from the property. But most of the time, if you're looking at a traditional bank, like you said, they're just looking at long-term rents, where you might have a property that you know is going to make, 6 figures a year. This property on long-term rents might only be half that, if you're lucky.
right. And so some maybe non-traditional banks or investment groups came together, and with guys like Matt and other lenders, they were able to. Well, I don't know if you were probably not part of that process of creating the DSCR,
I
but
was going to
you're,
say, I
you're
don't think
lending on it.
I'm not that grassroots, but I
Yeah,
wish. But
but you have accessibility to it. But basically, now these lenders are offering this product that says, "Hey, look, we can take a look at the short-term rental income of this property to see if it qualifies on its own without saying, hey, your income is required to justify that." So, but here's the question though:
yeah.
does that property already need to be a short-term rental to be able to do a DSCR?
With some lenders, it does, but most of the time, no. So this is where you get into the weeds. Is every lender has their own guidelines, and
Mm,
you really have to underwrite that property to what lender you're sending it to. And there might be reasons that I'm going to use, and this is where a broker like myself has some advantages, because there's definitely situations when I would never go to lender A versus lender B. And a lot of it just comes down to, is there a history? Because if you have a history of an income, you're going to be able to use it. That's going to trump just about everything.
hmm
So even if it's a terrible history, if it can pay payment and just cover the debt service, we're done in most cases. We might still do an appraisal on what the rents would be as an STR, but we don't necessarily have to have it if we have a history. But then there's lenders that won't even consider it that way. So we have to start going with other methods like using AirDNA, which is honestly a terrible way to underwrite a loan, because I mean, the AirDNA numbers could be so inaccurate, but we have programs, believe it or not, that'll go straight off of what AirDNA says the revenue is. If we'll take 80% of that number, and we'll say that should be enough to cover the debt, and you're done. And that's always a good way to go because we know we can use it. If that doesn't work, then we have to go to an STR appraisal. And that can get challenging because now you're limited by geography on what appraisers will take that order. And you have to get that appraiser to play ball. Um, we've also got a fourth method now that seems to be working quite well, where we
Ooh,
just send out any appraiser and they just do the appraisal on the value. And then we have a separate commercial appraiser do an STR income based on comps. And that can be pretty valuable because that way we don't have issues where there's just no appraisers in an area that's willing to do it. Like the Poconos, for example, is a really difficult area to get an STR appraisal, but we can now send a regular appraiser, local appraiser, to appraise the home value, and we do a second piece based on the income with a commercial appraiser.
gotcha. Okay. That's really good. You've said something, and I want to sit on something here, a topic that comes up a lot that I get in debates with people on privately. So let me throw an example at you, and I'm going to tie it into what you just said too. Um, I let's say I have a property and it is generating $200,000 in gross revenue, which is awesome. Okay. Well, now I have a rent roll of at least a year of it generating $200,000. Fast forward to, or now I want to sell that property, but I want to sell it based off of the income of the property. And I'm assuming that, or I guess the question I want to ask you is, can somebody get a DSCR loan purely based off of the income potential or the current income of that property?
No, I run into this all the time where somebody's assessed this property at $2 million because of the income approach, which is a valid number. It's worth every penny of that because it's producing this kind of revenue. But the underwriter is always going to assume that they're going to get this property back if things go south.
Hmm.
They don't know what's going to happen to you, regulations, who cares? At the end of the day, any mortgage is going to look at it like worst case scenario. They're going to get this thing back. And if they do, they're going to be selling it as a foreclosure with all the other houses around it that didn't do that well. And they're going to have to assume that that sales comparison is what it's really worth. So to answer your question, can we use the income to qualify for the ratio? All day long? We'll use that all day long. But does that mean that your property is worth more because it's making so much money? Absolutely not. It might be worth more to me as a buyer, but it's not worth more to the lender in the sense of the collateral doesn't support it if it's really only $100,000 house or whatever, you know.
Yeah. Yeah, that's really, I think that's really important for our listeners to, I see these all the time where they're like selling it. It's like, well, it's generating 200,000, therefore it's worth, 1 million. And
Oh
it's like,
yeah,
yeah, well, if we appraised it, it'd probably appraise for $600,000.
exactly.
That's what the bank's going to finance it on, or the lenders are going to finance it on, even though you could still get a DSCR, because you've got the income there. It's going to cover the mortgage payments because they have their rent roll. But that doesn't mean the bank's going to lend you the million to cover
No,
that property.
that's
So,
why we do two parts to the appraisal. It's even a separate form. There's your regular appraisal, which is no different than any other appraisal where they compare sales, similar properties that have sold that aren't STRs. They could be just somebody's house. And then they do a separate form where they look at the income.
that's really good. So tell me, you said something before we hit the record button about DSCR loans and that process that makes them different than normal loans.
Yeah, I think that what you have to realize if you're doing a DSCR loan, while we can look at your personal assets and credit all day long and say, yeah, this person's credit worthy, we don't really underwrite the loan until the appraisal's finished because the income is what's qualifying for the property on the property, right? So you've got a little bit of a backwards scenario here where you've gone under contract, you've done it, you're expecting to buy this place. We've told you you're pre-approved, but in reality, we can't really pre-approve it until that appraisal's finished because there could be some wild cards in there that we just don't know about. We can base our approval on what we think the appraiser is going to say if we need it, or if we have a loan that'll allow us to use the air DNA, we can base it on that. But in some cases, there's this little bit of a reverse process that happens. And so you just want to make sure that when you're using a DSCR, you give yourself a little bit extra time so that when that appraisal is reviewed, that you don't have any problems.
Okay. All right. So for those listening, it's just a little more complicated to do a DS. Doesn't mean it's not the right way to go or anything. And we're going to talk about some of the benefits. I think we really need to hit on the benefits here. But it's important to understand the process and how you don't just wake up one day and say, "Hey, I'm going to do a DSCR loan." You need to shop. You need to talk to different lenders. You need to hear what the rates and the terms are going to be. And then you also need to understand when you're looking at a particular property. Do I believe it's going to appraise? Because that's a big piece of whether or not you get that property. All right, let's move and talk about some positive light on DSCR loans, because I think it's really important that we focus on that too, because they are really beneficial for a number of reasons. Matt, what are those reasons?
Well, for starters, if you already have a couple properties or you're self-employed, DSCR may be the only way you qualify. If you're looking at a traditional loan, once you've um, maxed out, is what they say, you have too many properties or you have too much on you're not your tax returns might show all kinds of write-offs with your properties that are really helping you from a tax position, but when you get down to trying to get your next property, it can really limit you on what you can do. um, Also, your traditional loans aren't going to use STR income, and you may have a property that really is going to be a cash cow. You're confident it's going to do six figures or more, and the you know we can, if we can document that, the property can qualify for itself. Um, I think another reason that people tend to gravitate towards the DSCR is just the ease of them. There's not a lot of paperwork with them. I only need four things to get you a DSCR approval. You know, credit, proof of down payment, ID, things like that. Whereas if you're trying to go with, especially if you have business or multiple properties, I might ask for 400 documents from you trying to qualify with a traditional bank loan.
Yeah,
And so there could be a lot less stress with trying to get it done. It's just, I wouldn't say the DSCR loans are a negative thing at all. In fact, they're a great product. We just have to have enough time and want to make sure we have the right data that they're going to work when you go into it.
absolutely, absolutely. I really like that. I'll tell you a little bit about my situation. So we are looking to, get a bigger home. We're kind of growing out of our 1,700 square foot house, and we're like, hey, we need a bigger home, and so I can't go out. I also need to. I'm planning to purchase another short term rental at the beginning of 2025. I'm also planning to move. But I can't, if I go purchase a short term rental and I put it under my debt to income, like put it on my name, all of a sudden my buying power becomes a lot less for that primary residence. If I go buy a boat or another car or something
Yeah,
like that, buying power, because it's all under my name, it becomes a lot less. And that's where the DSCR. So all the recent purchases I've done, they've all been in DSCR loans because they're not in my name. They're in an LLC, a business, and the business takes that on. And I have a record, so I can show my, okay, I've been short term rental history, and show that I can do this and pull this off. So it's actually quite a smooth and easy process for myself to do it. And as we scale and grow, I think it becomes almost the one of the main loans that people will be leveraging out, to get to the
absolutely.
next level, because you don't want it to hold you back in your personal life, like taking on all these loans to hold you back and paint you into a corner. What are your thoughts on that?
I agree completely. I think if you're really trying to keep this a separate business onto its own, having in DSCR is the way to go, because now you close it in LLC, and not just that, but from an asset protection point of view, you don't actually own it. Your LLC does. Your name was never on the loan. You were never somebody that they can. I don't know. From what I understand, I'm no attorney, but from what I understand, it gives you a lot more protection that way too.
Yeah, yeah, for sure. So, um, Let me ask you this is opinionated question. There isn't a right or wrong answer to it, but I want to hear it from a broker, from the horse's mouth. Okay.
Okay.
Scenario: I'm a new investor looking to purchase my first property. Should I consider a DSCR loan?
I guess I would say you want to consider all options and weigh out the pros and the cons. We typically give you an approval both ways. And in some cases, DSCR isn't really the way to go. But a
Mm,
lot of times, it's going to give you more buying power. A lot of it is more about how much are you able to invest than what type of loan should I do. For example, if you're looking in a market where you can easily get something up and running for less than $75,000, which is almost impossible to do. A lot of people think that that's an easy, attainable goal,
yeah.
but typically it's more like 150,000. But
Mhm.
if you have limited capital, you may not be able to do a DSCR because you're probably going to have to put a bigger down payment, especially if you're a first time investor.
Mhm. That's a really good point. And I like what you said there. You gave a really good political response there. You should be running for senate or something in Utah. Go replace Romney. So I know he retired recently, but anyway, no. But
Uh,
I like what you said that you do is you get people when you approve them. It's you said you do both. You look at, hey, we can approve you for this much for a second home loan or this much for a DSCR.
Well, and we also have a kind of a hybrid option with some investors that'll do qualifying with things like bank statements. And we'll even be able to do a business purpose loan in the name of an LLC using your personal income if it's for a commercial use. So you can avoid some of these things like having it right under credit and still qualify a more traditional route. So having all in other words, don't limit yourself out of the gate and say, oh, I was told this is the way to do it. There really isn't a right way to do it. It depends a little bit on your situation, a lot on how much you have to invest, and a little, and then you kind of have to at some point come back to your comfort level. Do you want to leverage yourself a whole lot, or do you want to have more skin in the game? You know?
Hmm. Hmm. No, that's really, and yeah, that the risk tolerance level. I talk about that a lot. Like, what's your risk tolerance? It's different for each person, and there isn't like, oh, well, if your tolerance is X, then you should do all these different things. It really is a personal choice, but like you said, working and speaking with people who understand, lenders who understand what your options are is really, really important beyond just like, you can only do this. I can't tell you how many times, I'm sure you get it too. Yeah, especially you, but I can't tell you how many times people come to me and they're like, well, my lender said I could only do this one product. And I'm like, cool, but have you like, what about this product or this product? And they're like, I have no idea what those are. So I'm like,
Yeah.
they only offer that one. That's
Well, and I
yeah.
think that's where you need a lender that's also an investor because they you kind of have to think like an investor to do investor loans. Um, but that said, I mean, I feel like another thing you really have to weigh in on is, um, don't buy a property just because you can, or put yourself in a corner. Buy the right property. Buy one that's going to make lots of money. Don't come into it with all these expectations of, oh, I got to hang on to my money so I can buy 4 properties this year. If you buy the right property, it might make more than all 4 of those properties. And that's where Kenny and people like you that help find properties are so valuable is, pointing them in the right direction so they're not making emotional decisions. As a lender, I'm constantly trying to work through people's emotional decisions about why they're buying this property when they're not buying it on the numbers.
Right.
And I can't tell you how many bad properties people they bring to me. And I'm just like, guys, this isn't going to make any money. Why are you buying it? Oh, because it's only an hour from our house and we want to be able to use it. Well, that's great if that's the reason you want it, but are you buying this to use it? Or are you buying this to make money?
Yeah, I love that. Yeah, I ask that same question a lot of folks too. I'm like, is this an investment or is this, for a lifestyle asset? Are you doing this for pleasure? And if you are, prepare for it to not cash flow. so,
Yeah.
so
And
yeah.
And I
Because
ask people
it's
that
not
a
going to make
lot.
sense. Yeah.
And they're like, "Well, it needs to be both." And I'm like, "Well, it probably won't be." That's what you need to realize that,
Right.
this is where I made, and I, like a lot of people, I bought my first STR as a lifestyle asset that was supposed to make money. It was supposed to do both, and I sold myself on it. And now that I know what I know, I would have never bought that property. I'm glad I have it. I don't want to get rid of it, and I've got it to where it's doing pretty good. But it'll never do what some of these other properties are going to do. And just because I wanted a beach property doesn't mean that that was the best investment to me.
Hmm. I love that. I love that. Great. Well, as we kind of wrap up here, Matt, tell us number one. So I always like to ask this question at the end. What's one tip that you've given lots of tips and nuggets already, but what's one tip to help people cash flow positive, whether through financing or lending or anything with short-term rentals?
Make all your decisions based on the actual numbers using performas. Really get deep into the weeds on the numbers. Don't just buy something because it's something you're emotionally tied to, that has something that you'd want to enjoy. Odds are, you don't know your market as well as you should. You really need to buy what that market and what that avatar is best for that avatar, and focus on buying the right property for that. And I think if you could, remove your emotional response on, oh, I love this property, I love the view, whatever, and just really come back to, is this the right property for the person that's going to go there?
Hmm. That's good. And I really like that. And I think it all ties into like, with the guest, understanding your guest avatar before and doing the market research before you start hunting for properties, right? Like people
Yeah,
think you're in a mountain market, so naturally views are the best thing ever, but it could be like location, you know? Could be
yeah,
you could be in the middle of nowhere mountains and have amazing views, but no one wants to travel that far, or it's too remote to get to. So there's all these, elements. So it's understand. I love what you said there. Understand the guest avatar and do your market research first. Make sure you run your numbers, and that's why a lot of people listen to this podcast is they understand that. Run your numbers first. So hopefully they
and,
understand that.
and don't be afraid to hire the right people to do it. You don't know what you don't know, and at the end of the day, there's people out there that you can team up with. Kenny's group is awesome, and we'll lean on them, ask them, they'll help.
Yeah, I appreciate that. Well, thank you so much, Matt. Um, Matt, how can people get in touch with you, your brokerage, if they want to learn about your loan products and your lending options?
Yeah, you can go to the strloanguy.com. It'll take you to my link tree. You can read all my Google reviews, schedule a meeting with me. Usually I suggest just scheduling a quick 30-minute meeting with me so we can discuss your objectives. And then from there, I'll send you the information you need to get started.
Okay. And that's strloanguy.com. For those watching on YouTube, I've got a little banner down here. Is this correct, Matt? I want to make sure that's
Yeah,
the right
the
or,
STR Loan
oh,
Guy.
is it the?
They both work, but it's
Oh, they both work. Okay, he's got
yeah.
yeah. I did check it. It took me to your link tree, so you
They
can put a
both
D
work.
in the front. But yeah, great. Well, Matt, thank you so much for being on. This was really interesting conversations about commercial loans and different types of loan products, what works and what doesn't, and people's situations. But the biggest thing that I've gathered from this, guys, is every person is different. Every person and their situations can be slightly different and unique. And so the best thing to do is pick up the phone and call and talk to people like Matt who can help you and guide you and display options. If somebody isn't giving you options, in my opinion, they're probably not the right person to work with. So
Agreed.
yeah,
Agreed. And
I
and and
just,
they shouldn't be afraid to tell you, uh, don't do it. And I think, anybody that's just trying to talk you into something, be careful.
yeah, yeah, absolutely. Sweet. Well, thanks everybody for listening. If you enjoyed this episode, be sure to like and subscribe. If you're listening to this, you can go check it out, the video on our YouTube channel, Cashflow Positive. My name's Kenny Bedwell, and I hope you enjoyed this episode, and I'll see you next week.
Thanks, Kenny.